Okay, and welcome back, students who are taking financial accounting. In this series of videos, we're working on the Chapter 5 short exercises that were assigned as part of the homework for in your digital study guide. Before we get started, if you've watched some of the theory videos, you hear me say this again and again. Realize that doing the homework problems is the application part of it. And if you understand the concepts and you're working through the problem, that's the application. And if you make a mistake, you make a mistake, and if you can't find the mistake, that's what the videos are for, in order to be able to help you understand or see where you made your mistake. That's the application side. If you don't understand the material, you don't understand the concepts, that's a whole other story. You're not going to get the application if you don't understand the concepts. So if you're going through these videos and you still don't understand what's going on, then most likely you're lacking something as far as theory and concepts is concerned. So go back and watch the theory videos, go back and reread the chapters in the textbook. And if you still don't understand the concepts or still don't understand how something's arrived at, then definitely call and contact an instructor. Okay, so with that said, which I say at almost every video, let's move on to our short exercises. All right, so get my pen. All right, here we go. All right, so it says here, Cunnington Furniture doesn't expect prices to change dramatically and wants to use a method that averages price changes. All right, so one, which inventory method would best meet Cunnington Furniture's goal? Well, if they want to average the prices, then of course the average cost method would be the method that they wouldn't want to use. Well, let me read the second question and then give you my thoughts on this real quick. What if Cunnington Furniture wanted to expense out the newer purchases of goods instead? Which inventory would best meet that need? Okay, so if they want to expense out the newer purchases, then of course that would be LIFO. Okay, the last ones in would be the first ones out. So if they want to expense out the newer purchases, well, the newer ones are the last ones that went in, and that's why you would choose the LIFO method. Okay, so let me just quickly give an idea here. You know, when a business you don't make changes in midstream, right? Um, an accountant has to decide early up front whether they want to use average cost, specific ID, FIFO or LIFO. Now, you generally you're going to make this choice and you're going to stick with it. Is it to say that you can't change it someplace down the road? No, it can be changed someplace down the road, but what you can't do is you can't bounce back and forth, back and forth, back and forth between, different ones trying to suit your needs for that particular moment in time. I mean, if you have a car lot, most likely you're going to choose specific ID and you're going to stick with it. It makes no sense to try to use average cost or FIFO or LIFO. I mean, maybe possibly average cost if the price of the cars that you're purchasing are all just say right around 30,000. But since you're buying and selling one specific thing, you're gonna choose specific ID. You wouldn't want to go and change your inventory methods if you first decided that you wanted to use FIFO, and then later on you decided, oh, I want LIFO. Well, you have to have a good reason to change that inventory method. And as long as you have a good reason, you can change it. However, you're not going to change it just for a month or two or three and then go back, because what you're doing is you're playing with the books. You're not staying consistent. Um, Generally accepted accounting methods allow for that, one-time change. or if the business grows to a point, you can make another change, but it's not something that you look at your books this year and say, I want to do it this way because I make the most profit this way, and then the next year I change it to a different method because, oh, that's the way I make the most profit that way, and then the year after that I change it again because the accounting methods will not, generally accepted accounting practices will not allow for that, right? So one, you're going to choose a method. Now two, aside from specific ID, which is obviously easy, how would you choose whether you want, FIFO, LIFO, or average? Well, and this is what this question is kind of like asking. If the price of the items, and let's say, I'm just going to pick a number here, the items generally run right around $10. I mean, like 9.80, 10, 10.05, right? Depending upon whatever it is. And it kind of like stays consistent over a long period of time. And if you have a lot of them, it makes sense to just average things out, okay? Because it's always going to just hang right around that $10, and it just makes life more easier. But we know that if you buy something for $10 and over time, the price increases to say $15, okay, just because of time, right? Well, if you have a product that is going to increase, you're going to have to decide whether you want to use the FIFO or the LIFO method, okay, instead of the average, because the difference, I mean, you're talking about a 50% difference here between prices in the price, 50% increase. That's not average. Average is sticking right around there in that, 5% range, right? It stays within a range of like 5 or 10% of whatever the mean price is going to be, right? So, if you have a product that stays the same, you'll choose the average. But if it's a product where it's going to fluctuate, and you have to pay close attention to this. If it's going to go up and just keep on going up, then you're going to want to decide whether you want FIFO or LIFO. If you have a product, let's say, I'm just thinking about, let's say you manufacture O-rings for jet engines, and they're made out of aluminum, okay? Well, the price of aluminum, the price of commodities, they go up and they go down. And you're going to basically, you're taking a guesstimate and you're kind of like forecasting and trying to decide which method you want to choose to be able to reflect your financial position the most favorably. And that's the bottom line. You say, well, why would I choose FIFO versus LIFO? The bottom line is how much profit you expect. Okay, remember, if you expect to be profitable, right, where your revenues are greater than your expenses, right, and you're going to have a profit, and this is kind of like what you expect and project, then having a last in first out is probably the better method for you. Why? Because remember, when you're taking it out of inventory, you're moving it over to cost of goods sold. And that cost of goods sold is part of this expense. So just giving numbers here, if I had 100 in revenue and I had $15 here in expenses, that means I have a gross profit of $15. That means I have an $85 gross margin. Whereas, and let's assume that, and I'm just trying to clarify this point here as to why you would choose one method versus the other. Let's assume you have no other expenses, so your bottom line would have been $85. But now let's take, in the case of FIFO, where you have $10 is going to be your cost of goods sold. Now you're at 90, okay? And if you take the same zero expenses, now you have $90 as your profit. You're going to be taxed, okay? You're going to be taxed, right? And which would you rather pay tax on? Would you rather pay tax on 90 or would you rather pay tax on 85? Well, obviously you would want to pay tax on 85 because you're paying tax on, you're paying less tax and you're saving money. And you might kind of like think, this doesn't really matter. I mean, 90 versus 85, that's $5, and let's say tax is 6%, and you're talking about only 30 cents, all right, in tax on $90 versus 85. But businesses don't operate on 90 and 85. They operate on thousands and hundreds of thousands, right? If my profit is $100,000, Okay, and I'm I'm paying 6% on that, right? That's $6,000, right? That's a good chunk of change. Okay, so deciding whether you want FIFO or LIFO makes a big difference, and realize that it's not just just the tax implications. It's also the way you want to see your financial position. Okay, um, and you have to really know your business um, in order to be able to determine which method is the best for you. Okay, all right. So that one was that one, and sorry I went into that long spiel on it, but I don't think I covered that before, as to kind of like, you see these methods in the book, but and you read one quick line, but you really don't understand the implications of it. So hopefully that makes that a little bit more clear. And with that, I'm going to stop in this video and pick up on the next in the next video for the next problem.